Welcome to Personal Development and Motivation Foundation, where you enhance your knowledge with our educational resources. The outline will run from investing in stocks and bonds, investing in mutual funds, comparing to a savings account, risk to reward relationship, a negative return on investment, time horizon and risk tolerance, and lastly, a practical scenario. Stocks are securities that represent ownership in a company. If the share of stock increases, the value of your ownership in a company increases. Bonds represent loans, in which a company or government entity is essentially borrowing money and issuing you an IOU, promising to pay interest and to return the amount that was borrowed at a future date. An IOU is a phonetic acronym of the words IOU. It is a document that acknowledges the existence of a debt. Mutual funds represent a combination of the two by purchasing shares in a grouping of stocks or bonds managed by an investment company. Despite the volatility, historically, the average return over a given period of time on investment assets outperform what can be earned in safer interest-bearing accounts. Unlike a savings account that offers savers a set interest rate, money invested in stocks, bonds, and mutual funds does not have a defined interest rate when you invest. Instead, they seek a rate of return on the investment. There is no guarantee of what you will earn on your investment. There is both the potential for gain or loss, and there is no guarantee that the money will grow. This is what we refer to as risk when discussing investments. Investing involves a risk-reward relationship. Generally, the lower your risk, which is found in savings accounts and certificates of deposits, the lower the return. Conversely, high-risk investment like stocks, bonds, and mutual funds offer a greater potential return on your investment. Investment vehicles, such as stocks, bonds, and mutual funds, tend to fluctuate in value based on various market-related and economic factors. While in most cases, historical return in this type of investment represents high overall gains, it should be expected that market or economic conditions may also result in negative rates of return or a lesser return than expected. Smart investing requires that you choose investments according to your time horizon and risk tolerance. Your time horizon relates to your life stage or the time you think you will need the money. Risk tolerance relates to your ability to withstand changes in the value of your investment that may occur from time to time. For example, if you're investing for retirement that will not come until 25 or more years in the future, you can afford to invest in a more risk-tolerant way, taking a chance on a high-risk, potentially high-return financial vehicle or tool. Even in years of negative return, the account has time to recover and make up losses before funds are ever needed. If, on the other hand, you know you will need the money being invested in 3 to 5 years, it makes sense to limit your risk exposure by making low-risk, low-volatility investments. Trust you enjoyed the ride. Do well to subscribe, like, comment and share this content. Equally support this project by reaching out via email, personaldev.motivation@gmail.com, telephone and WhatsApp, +23768 139 2760.